Hello everyone, it is Sunday, August 15th, and this is episode 26 of Odds Are, your S&P 500 weekly market forecast. Alright, let's take a look at last week. You can see here that we did have a breach of the upper 4454 breach point. So we crossed that there on Friday. Actually, we breached it on Thursday and then continued past it on Friday. Now you'll notice that we also stayed within the upper limit of the Bollinger Band there, the blue shaded area, and above the Bollinger midline. And we also stayed within the expected settlement range of 4308 to 4508. We did not come close to the lower breach point or the lower settlement limit, and definitely not the parabolic SAR. All right, let's take a look at the moving averages for this week coming up. We are bullish still across the board. No change there, new all-time highs, so that is keeping everything in the green. And now let's take a look at what the odds are for next week. So for next week, we've got breach points at 44.28 and 44.79. So those are the lower and upper breach points, with an 81.22% chance that we will have a breach of one of those 2 points. And then our expected settlement range for the week is going to be between 43.39 and 45.40, with a 79.05% chance that we will stay within that range. The parabolic SAR has gone up by 20 points from 42.34 up to 42.54, and still well outside of the expected settlement range. Let's see here. All right, and let's wrap this into the relative view for next week. And you can see that we're closer to the upper breach point, but that is also right on the upper limit of the Bollinger Band range. And so we have a lot more room to the downside there on 44.28 if we breach that point. So if we breach down, we got plenty of room to play with and still stay within the expected settlement range, being above 43.39, which also happens to coincide with the lower limit of the Bollinger Band. All right, if you didn't see that one coming. Now, this is actually going to be for next week, right? So last week, yeah, we had a breach of the breach points. We knew there were pretty high odds, 81% chance that we're going to have a breach on any given week. So that should not come as any surprise. If it does come as a surprise, then you need to start back, watching from episode 1. But I'm going to pull up the relative view again here, because something interesting that I noted was that when you see the upper Bollinger Band, right? You see how it like curves up and then just takes a sharp downward move there at the top. So it's interesting that went down, and then look at the lower part of the Bollinger Band, how it just spiked up. Now, there's a couple things going on here. So the Bollinger Band is actually contracting, right? Because the volatility is going down. And so as the volatility goes down, that like channel, right, that is represented by the blue shaded area gets smaller. The other thing to notice is that since it's getting smaller, we also see that the breach points, that range between the lower and the upper breach point, is also getting smaller, which makes it even more likely that we're going to have a breach, even though historically we just say it's about 81% all the way across. But looking at this chart, like I mentioned before, I think we have a lot more potential to cross the lower breach point, which is the 44.28, and then still close within the 43.39 range up to 45.40. I don't think we're going to even get close to that 45.40. What I'm saying is we're going to go down below 44.28, and that midline of the Bollinger Band, that red line that goes across between the blue shaded area, I think that's going to provide a little bit of resistance. But you can see just about 2 weeks back, you see where it did cross that red line, it didn't really provide much resistance at all. It went all the way down to touch the lower end of the Bollinger Band range, and then did a V-shape, rebound up. But for this week, that's what I'm saying. I see in the market moves here. So if you don't see that coming, then you weren't watching the show. All right, guys. And then I'm going to wrap this up with the quote of the week, which is by Mr. Brett Steenbarger, he's an author of a book called The Psychology of Trading Tools. The Psychology of Trading, Tools and Techniques for Minding the Markets. And he says, routine is necessary for efficiency. Breaking routine is necessary for adaptation. So anybody who has created a system or has a set of rules that they trade by, you understand that it's very, very important to stay to those rules, maintain discipline, and to become efficient at this. This is something that has become second nature, right? So that's where that routine comes into play. But what happens when your routine is not in sync with the markets? Whether that be because something has fundamentally changed, because maybe we're just not in the right part of the cycle. Maybe your routine works best when we're in a early bull cycle, or things like that. It's one of those things where, yes, you need the routine, but if you stay stuck in a routine and you will die by it, in spite of what the market may be screaming at you, in spite of what the data is telling you, if you just stick to a routine for the sake of sticking to a routine, then you are not allowing yourself to be adaptable. You're not being flexible. You're not, moving with the market. And that's the trick, right? You got to maintain the routine, but adapt the routine and evolve the routine, and that's where that adaptation comes into play. So always take a chance to, if you this week, if you have a chance, take a look at your routines, take a look at what you're doing, and ask yourself, am I doing this just because this is what I've always done, or am I doing this because it's the right thing to do today and it's something that I'm comfortable with going forward? All right, with that in mind, guys, enjoy the rest of your week. I will see you guys back here next Sunday.